Hey guys, I hope you are well. Mandilake here. Thank you so much for joining us on this YouTube channel. We definitely are excited to have anyone who's joining us for the very first time. We hope that you will get to subscribe so that you can get notified whenever we are uploading any new videos. For those who have been with us, thank you so much for the support. We do see you subscribing. We do see the likes, views, and comments. We appreciate that a lot. Without you, we are just making noise and it does not make any difference. I don't want to take too much time before I get to what I want to talk to us about today. I actually want to speak to our employees once again today. Remember, my main focus at this particular point is to ensure that we empower our employees. It's mostly around South Africa so that they can understand what is the reason for us doing what we do. Because we're not just going to work because we love work. Some people do say that they do love their work, and I understand that. That's the awesome thing. For some of us, we feel like we're doing what we were called to do. However, over and above the work that we do get compensated the same. We do get paid in the form of money, and the categories in which the money is paid to us they differ here and there. However, when it comes to the aspects of regulatory requirements on our money and some of the things that erode the value of our money that we're getting. Some of us are getting paid a lot of money. It's just that the things that get to eat up on that money, they cause us to be left with very little at the end of the day. To such an extent, we feel like we are always set to go for the next increase or for the next job in order for us to actually get that bump, because of cash flow is not always our friend. And I want to talk to us so that we can find ways and strategies in which we can alter that, or we can change those circumstances, because we don't have to continue the same way. I like what Jim Rohn says. He says, if you don't like your address or where you're at currently, you can change. You are not a tree. And that's very key for us when we find ourselves in positions that we don't like a job that you feel doesn't pay you enough. I mean, really, you at the end of the day are there so that you can get remunerated, so that you can be able to fund your life, whether you're funding your lifestyle or you're buying assets with it. However, at the end of the day, your main objective for being in that job is for you to be paid so that you can do the things that are necessary. If you're not happy with what you're getting paid, that means there's something that's lacking, or there's something that's suffering in your life, either the lifestyle or the assets that you are planning to increase or that you are investing in. And we want to then look at what are the enemies of our salaries, what are the enemies of our income growth as employees, because I want to address that today. Each and every one of us that is employed, I think we would have probably started at a point where we either left varsity or left school and then we got into corporate. Actually, I also want to break it a notch down, because there were some people who were saying in some of the videos that I've posted, they said, I wish this video was speaking to us who are earning like 5,000 rands. So I do understand some people didn't go to university, and some people probably might not have even completed matric, and that is not the worst position to be in. And I want to emphasize that, because we have had people that have been lost in the system because they were not cut in the manner we want them to be cut in order for them to actually make it in life financially. Yet we are seeing in other parts of the world that not everyone who is successful financially went to varsity or finished school. School is imperative. Education is pivotal. However, I'm just trying to drive a point home where we don't lose people because they didn't do the things we want them to do. Some people are not meant for corporate. So if they're not going to go to corporate, if they didn't go all the way to university, there are other things that they might do that could earn them money. And we have to grant them those opportunities and give them a chance in life so that they can understand that they don't have to consider themselves failures by virtue of them having not finished education. Because right now, I mean, there's a guy called Speed, I think in America, something Speed, but the chap is just fast on any, he's just trying all sorts of sports, and he is making millions of dollars. And I don't know how much education the chap does have. However, what he does not require much of education because he's got skills. So you've got people that are gifted, and they actually use their gifts in order for them to generate income. That is not the main reason for my conversation today, but my main reason is I want to look at what are the enemies of the money we're making, whether you are highly educated and you're getting paid as an employee in corporate, or you might be working at a grocery shop and you are a cashier, but you also still do get paid in a form of salary as well. Or you might be someone who's actually just selling stuff for yourself somewhere in the corner, and you actually are working for yourself on that one. There might be a little bit of a difference. However, we're just going to deal with the issues or the challenges that we have that concerning the growth of our income as employees. Firstly, employees are the highly taxed, and I always say this because you get taxed up to 45%. So at some point we will talk about the difference between being an employee and being an investor. Employees go up as far as directors of companies because shareholders are the owners of companies. We will break this down someday for someone. Shareholders are the owners of companies. Their income generation and the tax implication on their returns is different from someone who is employed by that company. CEOs, CFOs, and all of those people, even though they might be at the highest of the ranks when it comes to the corporate ladder, they are also employed, which means they also get subjected to employees' tax, and their employees' tax is calculated the same with everybody else. Just that if ever they have different forms of income that they're receiving, then that might actually need a different form of tax table to be considered. So we just need to know that they are subjected to the very same tax tables with everyone. That is a cashier, even if they're CFOs. It's just that in South Africa, as we know, that our tax tables are progressive. The higher or the more you earn, the higher the taxes. It starts from 18% from those who are actually earning from R1 up to a certain amount, which is I think about 217. Let me just quickly see if ever I do have any tax tables with me right now. But then there's the first bracket is up to 18%. I don't want to just to get distracted a lot on that. Then the last tax bracket is up to 45%. So someone who actually earns less will be in a different bracket by virtue of the tax bracket that they're falling into. So it's from 18%. It's got different percentages and categories based on the tax bracket. I just want to quickly see if I do have a the tax tables on one of my slides somewhere here. Yeah. So the first tax bracket is between R1 up until 237,100. The last bracket is anyone who earns taxable income, who has taxable income that falls within this bracket of 1,817,000 and R1. So it's 1,817,000 and R1. And that person gets taxed. There's a standard tax amount, which is 644,489 plus on any amount that is over and above the 1,817,000, they get to pay 45% on that. So if ever they have an extra million over and above the 1,817,000, the 450,000 is going to be subject to taxes. Can you see that? So I'm just trying to point out the fact that we are highly taxed as employees, and it makes sense because of the government is trying to incentivize whoever is trying to assist it in order to attain its objectives, right? And when we are working, we are earning money for ourselves. So we're not really creating for anybody else, we're creating for ourselves. So that's why our taxes are high and our tax benefits are lesser. However, we can do a whole lot about that in order for us to get exposed to more deductions, right? That's the first thing. So first enemy of our income growth or salary growth is taxes. or are taxes. Taxes are a huge part, as I'm saying, of the reduction on the value of the money we're making. If you are earning over that 1,817,000, you have to be willing to lose almost half of your money to taxes if you are getting it on the employment kind of setup. And I must say, that is your hard-earned money. It's your sweat and blood. However, it's taken. We have a lot of reasons why it's taken as taxes, and someday we will get to uncover or to actually talk more on what the government services are that are paid by the taxes that we are paying. At this particular point, though, we're not getting full return of the benefit on the taxes that we are paying. We're almost double taxed. I mean, if you look at countries that are taxed at the same rate, same way that we as South Africans are taxed, those countries have better infrastructure systems, better public transport system, better public health system, better public education system. And here in South Africa, if you rely on any of the things I've mentioned, you know that you are going to be disappointed. So it feels like double tax because you're getting taxed in order for the government to do a better job in providing better public services. However, you don't get that. So first thing, so if you can do something in order for you to reduce your taxes, it is a noble thing for you as a person. Patriotism can be shown by you doing good by ensuring that you are using what is available to you for tax benefits in order to reduce your tax expenditure, because the biggest expense in your payslip is your taxes. First thing. Second thing that I want to talk to is your inflation. Your inflation is what reduces the value of our money. Hence, there's this term, whether it's in accounting or it's in your cost and management or your finance, that says your 1 rand today is not 1 rand a year from now because of inflation. It means what you are able to afford with 1 rand today, a year from now, you won't be able to afford that very same thing. Why is this important? This is important because what you do with your money when it reaches your hands is very important in order for you to retain its buying power. What do I mean by that? It means if ever I have 100 rands today, and with my 100 bucks I can buy bread, I can buy butter, I can buy any other a cool drink. Maybe those things can come out of that 100 bucks today. But a year from now, the cost of the things I've mentioned, your bread, your butter, and the cool drink, will be probably twice as much in cost next year. I'm exaggerating, but I'm just trying to say the cost will go up of those things. So if I try to keep this 100 bucks so that I can buy the very same things I could afford this year, next year, it means I might not be able to buy all 3 items. I might be able to buy bread and butter and might not be able to buy that cool drink. So it's very imperative for me to understand that I have to keep my money in a format that keeps up with inflation, because inflation is eating up on the value of my money. So that's why putting your money under the mattress in this day and age is getting you poor by day. Very same thing as putting your money in your bank saving account. Its interest is normally trivial. It's below the it's below the inflation rate. That means on a daily basis, your money in the bank is losing value. That's why it's important for you to put your money towards something that's going to grow it so that it can grow at a rate higher than your inflation rate. So make sure that you look at this. If it's too complicated, speak to someone whom you know is well versed when it comes to this. The third thing I'd speak to is what is called a tax bracket creep. Tax bracket creep, what does that mean? It speaks to the fact that previously, it's about 3 years now that the Minister of Finance has not been doing this. Previously, the Minister of Finance in February, when they're going to do a budget speech, they would take into consideration the inflation rate when they are determining the tax tables in order for them to be able to tax South Africans, ordinary South Africans. However, today, it's been 3 years now, consecutively, meaning one after another, that the Minister of Finance has not been taking into consideration tax bracket creep, or has not been taking into account inflation when it's actually determining the tax tables which will be applied on ordinary South Africans, which are employees. So that means now you can get taxed more by virtue of you getting the inflationary adjustment from your workplace. Because what the tax bracket creep did, or what the consideration of inflation on the tax bracket did, was to take into account the fact that everybody gets an increase, which is a generic increase on their salaries because of inflation, which means it's an artificial increase. But now, if the government is not taking into account the inflation when it takes into account the tax tables, that means people who have gotten increases just to take into account the inflation rate will get to pay more taxes this year than they did in the previous year, which means then your take home is getting affected more negatively, because this right here reduces the value of your money. And now this also speaks to the fact that you have to make sure that you understand what tax provisions are there for you to utilize in order for you to pay less taxes. Otherwise, if you do not make use of the tax provisions that are there to reduce your taxes, you will end up paying more taxes, meaning you will actually end up with less money in your pocket, whilst things are rising gradually, generally in prices out there, meaning you will become broke by day. Why is this important? This is important because if that becomes the case, the amount of time you might have planned to spend in the working environment when you started working might have to increase, because you are going to work so as to buy yourself freedom. But if ever, by the time you plan to retire, when you reach that age, you realize that you don't have enough money to last you long enough for the remaining years, looking at the longevity of life today. If you look at that before you retire, then you find that the money that you have might not be sufficient for you to get to the end of your life. You would consider retiring late, which then would eat up on your health, and also it actually might just cost you your peace of mind. I'm going to just leave this there by leaving you with these 3 enemies of the increase to our salaries, increase to our income generation. I will add to this information on the next video. I hope you find this valuable. Please share your views on the comment section, and also do share your questions if you have any. It's been lovely talking to you. Mandilaka here. Have a great day.